This is Shelly Craft. We're coming to you live on SNN Live. We're at the ISEEE 2012. That's the International Stock Exchange Executives Emeriti, and we are here in Madeira, Portugal. With me is Deborah Fuhr of ETFGI, and she's a featured speaker at this conference. Welcome to SNN Live.
Thank you, Shelly. It's nice to be here.
It's good to have you. ETFs. Well, let's get right into it.
Well, ETFs are really one of the most exciting products that have come to market, probably I would say in the past 20 years. One of the things that is really quite exciting about them is they offer the same broad toolbox of exposures to both retail and institutional investors at the same annual cost. So everyone is able to get exposure to emerging markets, to gold, to fixed income, being able to buy or sell anytime during the trading day. And we're actually seeing that the net flows, so new money going into ETFs, is much greater than money going into mutual funds. And the reason for that is many mutual funds are not delivering alpha. So what is alpha? Alpha means returns better than the benchmark or beta. So at least if you know you're not going to get alpha, then if you go to beta, if you get your asset allocation right, so how much money should you have in the US versus Europe versus fixed income versus commodities, you can deliver alpha through asset allocation selection. And so increasingly we're seeing that investors are doing that. And this year, through the end of August, and we do research that comes out about 3 days after the end of the month, we see that $143 billion of new money has gone into ETFs. The majority, $76 billion, went into equities, mostly into the US and emerging markets. Then we saw money that went into fixed income, going into corporates, and also high yield, and precious metal. So precious metal, believe it or not, you can buy products that allow you to get exposure to gold bars that are sitting in vaults next to gold bars owned by central banks. So you're being able to get exposure, as I said, as retail or institutions at a very cost-efficient annual cost to products that are really appealing to investors around the world. And most investors in ETFs today are institutions globally. So 80% probably institutions all over the world. So we're talking sovereign wealth funds, pension funds, endowments, mutual funds, hedge funds like them, private banks, and financial advisors and retail. So it's really a compelling story because it allows you to do what you want, when you want, in a cost-efficient fashion.
One of the things that I learned while you were speaking today was how worldwide ETFs have become. Could you comment on that?
Sure, I'd be happy to. So, believe it or not, ETFs today are listed on 54 exchanges around the world. So it's really everywhere from Colombia, Chile, to Australia, Tokyo. We have ETFs listed in Saudi Arabia. We have them in London, in Milan. So they are a product which is available on many exchanges. You also find that you can find products that are listed in different currencies. So you can buy exposure to the US in sterling or euros, or you can buy exposure to Japan and yen. So those are some of the other features that you find. So the industry today, if you combine ETFs, which are exchange traded funds, so funds like 40 Act funds in the US or UCITS funds, or they're also taking the shape of what we would call products, and ETPs would be structured as notes or grantor trusts. So you need to understand that because the tax and regulatory treatment can be different. But if you combine all those products together globally at the end of August, there were almost 5,000 products with nearly 10,000 listings, 204 providers of these products with 1.8 trillion US dollars. So we've seen the compounded annual growth rate globally over the past 10 years is nearly 27%, which is quite significant compared to many other financial products.
You know, Deb, I want to get a historical perspective. Who created the ETF, and was it originally created for institutions? I mean...
That's a really good question. So many people don't realize that the first ETFs were actually created in Canada in 1990. Those first two products emerged and went away. So many people refer to the first product as coming out of the US, out of the Amex, and it was on the S&P 500. It was designed, I think, to appeal to both retail and institutional investors, but the reality was, in the early days, it really was appealing to people who traded. The early products allowed you to go both long and also short, And you could even go short when the last price was going down. At the time, in the US, we had what was called the Uptick Rule, and that rule was implemented in 1938, so it's been around for a long time. So if you wanted to short a stock, the last price had to be ticking up, hence Uptick Rule. ETFs could go short even if they were going down. So we had ETFs on the S&P 500, we had ETFs on S&P 500 sectors where we don't have futures, and so many institutions would use ETFs to equitize cash, to do long and short strategies. Over time, though, we saw that ETFs moved on to be products that allowed you to get access to markets. And by that I mean markets like Korea and Taiwan came quite soon after the S&P 500, and they allowed you, without applying to the governments in Korea or Taiwan for permission to invest, you could buy an ETF list in the US that gave you that exposure, and you could go short. Then it moved on to being in a product that many people just use as an investment tool because they found that it's hard to find active funds that consistently deliver alpha. Last year in the US, we saw that 81.2% of large cap active managers did not beat the S&P 500. That number hasn't changed much over time. So if it's hard to find good active managers, it's also hard for retail to do it themselves. So you find that people are spending more time looking at how to get their asset allocation right and embracing the ETFs to help them do that, given they cover so many different benchmarks and allow you, without any special permission, to invest in more segments of the market than most people would even contemplate investing in.
Thank you. That was a very informative answer. Another question. What is the state of, we know what happens to mutual funds when the market turns south. There's an increase in redemption. How is an ETF affected by a downturn in the market?
That's an interesting question. What you often find when there's a downturn in the market, people in ETFs often will stay in the ETF because they're using it as tactical asset allocation, but often when they do switch, they'll just buy a different ETF. So you might decide, many people have been concerned about what's happening in the Eurozone. And so what we've seen is people have decided, you know what, I don't want to keep money in Spain and say Portugal or Italy, and I'll move my money from those markets into the DAX, so German exposure. So people can very easily tactically adjust when, where, and how they want to invest, and you can do it any time during the trading day. With mutual funds, you have to remember that you can't do it any time during the trading day, so you can have a view that you want to be in or out, but you have to wait till the end of the day. With an ETF, you can decide right now you want to do it, and as long as the market's open, you can ask your broker to trade now, over the day, limit orders. It's trading just like stocks. And for retail, most of the online brokers in the US offer no commission trading. So it means the cost to use ETFs is just the annual cost, which we know is less than active funds, and it's also typically less than similar index mutual funds in the US.
Now, we have millions of people watching, and from investors to institutions, etc. We know that everything isn't great. So what concerns and what warnings, I like to disclaim, so to speak, that everything isn't great about everything, including ETFs. So give us a little warning that it's not good for everyone, etc.
Well, I think you have to do your homework and decide when, where, and how you should be investing. So think about, what are my goals? If I'm saving to put my children through university, I'm saving to retire, saving to buy a house, that's going to dictate where you're going to put your money, right? So you wouldn't want to put all your money into some individual commodity. You also need to look at the benchmark. So if you know you want exposure to, say, the US, investing in the S&P 500 is very different than investing in the Russell 1000 or Russell 2. So understanding the benchmark that best represents the exposure you want is important. And then from there, looking at the products. So you need to look at, is it really a fund or is it a note? And understand who's behind it, how it's trading. The size of the product is also important. So you need to make sure you understand all the components and then make sure you're buying and selling through a venue that really is supporting you in doing that. And there's many of the good ones out there. So those would be the simple things. So it's not always the right product, clearly, but it is one you should consider. And the questions I'm articulating, I think, are useful even if you're looking at using mutual funds.
Now, you know a lot about this. What's your background?
My background is I started as a consultant with Greenwich Associates. I then worked at Morgan Stanley as a managing director and head of Delta One Strategies for 11 years. I moved to Barclays Global Investors as a head of global ETF research and implementation strategy. I stayed there while BlackRock was acquiring them, and then last year decided to resign, and we set up a new company called ETFGI, and the goal is to provide independent research and consulting, so really tools to help people understand that array of 5,000 products, 10,000 listings on 54 exchanges. It's a huge task even for us to do it, and we're doing it full time, so it's hard for many institutions or even retail who aren't really spending that amount of time, nor do they have it.
It sounds like there's going to be research coverage on ETFs through you.
There is, and it's something I've done since 1997. So when I started, there were 21 ETFs and $8 billion, and most people had no interest in them. Today, clearly, there's interest from a lot of investors globally, both retail and institutions, financial advisors. But there's also, I think, a real interest from exchanges, from regulators. Many people want to understand these products. How do they work? How do they compare to other products?
And last but not least, my question is, where do you see the future of ETFs?
That's a good question. So if you look at ETFs today, the majority of them are index tracking products. I think we're going to see more products being used in new ways. So clearly there's a real need for education, because today most financial advisors outside the US are paid to distribute other products and don't look at ETFs at all. So they really need to understand them as regulations change, as looking at ETFs makes sense. So I think retail and financial advisors will be a significant growth area. Packaging solutions based on using ETFs as low-cost beta building blocks, whether it's target date, global asset allocation, et cetera, will be increasingly important. And I also think that we'll see more institutions using them, because clearly many investors have moved from looking at just their home country to Europe, to the world, emerging markets, but more importantly, multi-asset class. And ETFs covering all these asset classes makes it easy for people where their teams haven't gone from this size to this size to this size to represent all those new investment opportunities. ETFs are useful tools to consider. So I think we'll see more users, more money going in, more products, and continued success.
So tell me exactly what ETFGI will be doing.
Well, thank you for that opportunity. So ETFGI has been set up as an independent research and consulting firm with the goal of covering that global ETF and ETP industry. So given the huge array of product growth that we've seen, structured in many different ways with different assets, different expense ratios, different dividend policy, there's a real need for investors to be able to go to one source of information, find, search, compare. And so we'll be publishing a monthly report that's very detailed on fund flows, what asset class they're going into, who's winning market share, new product launches, expense ratios, index providers, the brokers, various metrics on the industry. We'll also be providing a PDF directory of the product. So for people who liked prior directories we made, you can flip through it online. So that'll be the annual service where we'll be offering access to those three components. You can buy one country if you're interested, and also be tiered. So if you're a big firm based on assets, you'll pay more than a smaller firm. And then we're doing consulting work. And consulting has been interesting because, to be fair, it wasn't something I was going to focus on, but even before the company was set up, through LinkedIn, many people contacted us. I have this group, ETF Network, with like 6,400 members, and we was getting requests to say, can you help me do this or that? So we've had quite a few clients ask us to do projects, which is exciting and fun.
Ladies and gentlemen, I want to thank Deb Fuhr of ETFGI for coming on to SNN Live and being a featured speaker at this conference here in Madeira. How do we get in touch? How do we keep finding out about you? Is there a website you'd like to give out?
Yeah, I guess etfgi.com, so pretty easy, is a good way to keep in touch with what we're doing.
And that's probably going to be a cool website. I guarantee that. Ladies and gentlemen, we are at the 2012 ISEEE, the International Stock Exchange Executives Emeriti, here in lovely Portugal. You're probably off to another country very soon. Am I right?
I'm going to Zurich, and then I'm off to Hong Kong.
She travels a lot, ladies and gentlemen. Deb Fuhr, thanks again for coming on to SNN Live.
Thank you very much.
You're
Nice
welcome.
to meet you.
You too.